Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
So here's the latest. All eyes on Fed Chair Jay Powell as he's set to speak Friday from Jackson Hole. The focus turning from when to how big and how many rate cuts the Fed actually delivers. Kelsey Berro of JPMorgan Asset Management writing the following. Simple policy rules would suggest the Fed could have already started easing by now. This was true even before the last jobs report, but further confirmed by the most recent CPI report. Risk-reward favours owning some duration in portfolios as we approach the start of the Fed's easing cycle. Kelsey joins us now for more. Now, Kelsey, language is really important. You say easing. Some people might say removing restriction. Are you talking about a shift towards accommodation of the Federal Reserve?
Well, I think you are rightfully so picking up on a little bit of a differentiation. So when I say easing, I think the Fed in their mind views that as reducing policy restrictiveness. But I think when I look at the environment more holistically, putting aside the conflicting noise that we're hearing in terms of the labor market and the consumer, is it really weak or is it really strong? I think the inflation backdrop alone at this point probably justifies at least 100 basis points of rate cuts, not immediately, but I think a policy rate closer to 3.5% to 4% is probably where we should be trending just based on the inflation data alone. And that's because inflation is coming down. It's more broad-based. It's really just concentrated in two categories at this point, shelter and auto insurance.
Let's get into that a little bit more, sort of set the stage for the economic backdrop, and then we'll get into the market call. The breadth of the decline in inflation, how encouraging has that been for you? Where is shelter? Is that still a sticking point?
It has been very encouraging. I mean, so if you think about the inflation or disinflation that we saw last year, it was primarily a goods story, and that was the low-hanging fruit. What we've seen more recently is that the inflation or disinflation has broadened out, and it's now included the services category. Now, the shelter category, I know there's a lot of hemming and hawing over, is it coming down? Is it coming down fast enough? But, you know, I look at the year-over-year rate, it's down 300 basis points, 3% over the last year. It's coming down, and I think it will probably continue to normalize over time to levels more consistent with pre-COVID, which is where the majority of the CPI basket is already trading.
You've been talking about this for many months. Basically, the rest of the market's come on board with you. And it seems like this is now consensus, and the market is pricing this in already. And some would argue has already moved for the Federal Reserve, which hasn't moved, and yet effective rates have essentially dropped that much. How disruptive would it be if Fed Chair Jay Powell doesn't lean into the rate cuts that are being priced into the market in his speech on Friday? Yeah, that's a really good question because, you know, I look at the moves in yields this year, right? And they've all been driven by data. Not one has been driven by Fed speak. It's the data that's driving the market's reassessment of how many rate cuts need to be done this year. And earlier in the year, when there was concern about reacceleration risk and there were a couple hot inflation prints, the market priced out rate cuts. They didn't need Fed speak to do that. So I guess where I'm circling back to is when I think about Jackson Hole and what Chair Powell's responsibility is, you know, I think what we're going to hear from him is that he is comfortable with the inflation backdrop. This is an environment where the Fed can start removing policy restrictiveness, but I don't think he is going to be particularly explicit about how many rate cuts that will be or how far they need to go. I think that they're going to kind of continue to let the market do that work for them. So in other words, he's not going to lean into it one way or another, which raises this question about the theme of the actual conference, which is reassessing the effectiveness and transmission of monetary policy. How effective and how much control do they have over the transmission of this monetary policy if all of the moves this year have not been driven by the rhetoric, have been driven by data?
Right. Well, I mean, I think that's because we've moved out of an era of true reliance on forward guidance. If you think about what forward guidance was and why it was created for an environment of the zero lower bound, right? It was when we cut to zero and we still needed to be even more accommodative and we had no tools left and we've tried quantitative easing, 1, 2, 3, what else can we do? Well, we can try to just jawbone the markets and continue to promise them low rates for longer. The environment we're in right now is not really an environment of extraordinary policy where the forward guidance that we need is that type of forward guidance. And so I think that the environment that we're in is one rightfully so where, the forward guidance is not what's most relevant. What's most relevant is where we are in the business cycle. And to be frank, we're all learning that together, including the Federal Reserve members, as they watch the data.
Kelsey, when you were talking about the data and the market moving data dependent, that's because the Fed told them they were so data dependent. So it comes from the Fed basically saying, we're so data dependent, the market should be data dependent. Does Jay Powell need to almost take a step back on that when he talks in September this week at Jackson Hole before the potential cut or keeping policy in line? Take a step back on the market. You shouldn't be so data dependent?
So I do think there's probably an opportunity for him to use words such as gradual to describe the easing cycle. So he's likely aware that commentators in the media and financial market participants have been talking about the need for intra-meeting cuts after the July jobs report, the need for potentially 50 basis point rate cuts. I think the data he's seeing on a mosaic basis is probably not suggesting a need to be that quick to move. And so while I think he wants to communicate that they have the capacity to be quick, if necessary, the current environment is one where they can adjust slowly and recognize that in the event that something goes wrong, we're in a great position to respond because we're not near the zero lower bound. We have 500 basis points of policy space. And that's also, I think what the bond market is picking up. And while yields are coming down, spreads are also staying very well contained.
I just want to say this up front, present company excluded. The last year has been dominated on this program by a bunch of people trying to sell some bond funds and to get out of cash. And I hear it again now, sort of scaring people out of cash to say the rate cuts are coming, extend duration, get out of money market funds. Why is now the right time to do that? Because I've seen head fake after head fake over the last 12 months when people have given up, say, 5.5% and rushed out to buy duration when they maybe didn't need to. Why is now the right time? Why is now different?
Well, I mean, I was just looking at the numbers myself, and, I said, normally the conventional wisdom is once the Fed is done hiking, which was back in July of last year, it's time to start extending duration. If you were to have moved just a little bit of that cash into 1 to 5 year high quality corporate credit, so 1 to 5 year investment grade credit, you'd be 200 basis points ahead of cash at this point, 13 months later. So I think the proof statement is actually already there. And that's before the Fed has even started cutting.
Kelsey Berro of JPMorgan Asset Management defending their sales pitch of the last 18 months. So here's the latest. The US dollar extending losses as traders await comments from Fed Chair Jay Powell from Jackson Hole on Friday. Expectations for a September Fed rate cut happened to push the Bloomberg dollar index to its lowest level since March of this year. Steve Englander of Standard Chartered writing the following. We now expect 3 25 basis point cuts from the FOMC for the rest of 24. We also expect steeper rate cuts in the first half of 25, totaling 75 basis points in Q1 and 50 basis points in Q2. Steve joins us now for more. Steve, welcome to the program, and let's start right there with your calls for 3 cuts this year and 125 basis points in the first half of 2025. Can you help us and our audience understand whether that's an adjustment based on falling inflation or whether that's a shift to accommodation to confront weak growth?
More the first. If we really see weak growth, which is not our baseline, but, 50s are in the picture. The 50 story is a very, a typical recession fall off a cliff story. We don't expect that, so we have 25. So I think as we get into 2025, with the unemployment rate drifting up and inflation getting closer to target, all the considerations of, how tight should real interest rates be matter. So that's why we think that they'll be able to cut more aggressively and bring the Fed funds closer to neutral in the first half. I think the Fed would prefer not to do it in 2024 because they want to be sure we're still on track for, getting target inflation, and they want to be sure if they do a 50 that the economy is in dire straits. But by 2025, they'll be more confident that they can do an isolated 50. We don't think it's going to be too many of them.
Steve, there are two very different conversations, though. There is a key distinction, and you've drawn it. The conversation about removing restrictiveness and a conversation about shifting towards accommodation. What does the dollar look like? How does it trade in one backdrop versus the other?
Yeah, the dollar is kind of interesting. We thought that the dollar would, because we're at saying 25 basis points. The market was somewhere between 25 and 50 in Q4. So as the market pulled back from those rate cut expectations, we thought the dollar would strengthen. What we've seen so far is that the asset markets and the currency markets are paying attention to the ebullience that you're seeing in equities. And, that's kind of been driving the dollar weaker, even though the interest rate moves have been more in favor of the dollar than against it. We have to see if that persists. There's still a long way to go before we entirely get rid of the 100 basis points, get back to 75 that we expect. So we as a baseline, we still think the dollar could nudge stronger. But 2025, we think, will be a weak dollar year because that will be, all systems go to basically get back to neutral. The Fed will converge with everybody else in rates terms.
Does it bother you, Steve, that the bond market disagrees with itself? That essentially you have Fed funds futures talking about your view of things, 200 basis points of rate cuts by the end of next year. But then you've got a 2-year trading at 4%. I mean, you start talking about the dollar before you even get there. The market can't agree with itself.
Well, I never asked the market to be entirely consistent because there are different segments in the market. But, the 2 years is kind of, pricing in that Fed funds, say by the end of 2025, beginning of 2026, will be around 3%. We're now at 5 and change. So the 2 years sort of averaging, where we are going to be versus where we are now. But I would say this, and I think this is really important. If it does turn out that we're in a typical recession, that, all the somber charts that on unemployment that everybody was pulling out, that this economy follows the contours of a typical recession, the market is way off base because Fed will take real rates to zero, maybe negative. So that would mean like a 2% Fed funds rate or even below. I think right now the market is pricing in a very comfortable sluggishness in the U.S. economy that, mostly 25 basis point cuts can deal with. If it turns out that's not the case, we're mispriced, and we could go back to the early August world where, equities are mispriced because the economy is a lot weaker and fixed income is mispriced because the cuts are going to have to be a lot deeper than, what's priced in now.
This raises a question going forward, and Jon was alluding to it, the idea of dollar weakness or dollar strength, depending on what kind of rate cuts there are. I'm wondering how much some of the dislocations or some of the overweights on the dollar versus the yen or things like that, how much those carry trades are really flushed out of the system last week, giving more of a clean slate that will lead to more controlled moves, not the same kind of violence that we saw.
From the indications we have, certainly what you call fast money, hedge funds, high frequency traders, they got out of their long dollar positions very, very quickly. So the market is pretty clean. There could be a few segments of the market where they're catching up. I think that the, positioning is much, much lower than it was 2 weeks ago or even a week ago. And it's certainly not in terms of dollar longs. Those have kind of disappeared.
Steve, just quickly, are you satisfied on a morning like this morning that we have broken the correlation between the Japanese yen and what happens with risk, given that equities are holding up okay this morning, even with a much stronger Japanese yen?
I'll say this. I never thought that the yen trade was what was driving global risk. It did drive Asian FX. I mean, that's why, all Asian currencies are strong. And it did drive the unwind. But I think that the big equity market moves that we saw and the big fixed income moves that we saw were driven by recession fears. And those could come back. It's not our baseline, but those could come back if it turns out that the unemployment rate keeps going up by 0.2% a month. And so we're not out of the woods yet.
We'll be playing this game again on September 6th. Looking forward to it. Steve, thank you, sir. Steve Englander of Standard Chartered. Secretary of State Antony Blinken arriving in Tel Aviv as Israel and Hamas truce talks stall yet again. Senior advisor to the President for Energy and Investment, Amos Hochstein, playing a key role in easing tensions in the Middle East for the Biden administration. He joins us now. Amos, great to see you. Widely regarded as one of the President's most trusted security advisors. You were in Beirut, I believe, in the last week as well. Can you set the stage for us? Just help explain to us where talks are currently, both between Lebanon and Israel, and what's happening currently in the Gaza Strip as well.
Well, first, it's good to be here. Thank you for having me. Yeah, I was in Beirut last week. We had obviously rising tensions and escalation of different reprisals and different threats across the region. The president had ordered large parts of military, U.S. military to the region, and of course diplomacy to commence as well to be able to reduce tensions. The most important thing that the president is focused on now that we want to achieve is a ceasefire agreement that brings the hostages home finally to their families, brings relief to civilians in Gaza, and sets the stage to end this war. That's the most important thing. So the talks in Doha last week, talks continue right now. As you said, Secretary Blinken is in the region. In Israel today, and I take issue with stall. I think that the press wants to have some, there's a movement every single day, but these are very serious discussions that will continue over the next several days.
Well, educate us. Where has there been movement?
Well, I can't, obviously, for obvious reasons, can't go into the details of the details of the talks, but they are progressing things. That's why Secretary Blinken is there, and the work will continue. This never happens overnight, but I'm confident that we'll continue to push as hard as we all can. And when it comes to Lebanon, look, we had a ratcheting up of escalation. We're trying to bring some of that down. I was there really to talk to folks about how do we think about the day after and talk about bringing some sense of normalcy for Lebanon. Look, Lebanon is at a war that I think its people don't want, that neither side really started. Hezbollah decided to join the conflict on October 8th, and we've been in a tit-for-tat ever since. So it's really important. That is a critical piece not to allow to escalate as it has ramifications for the rest of the region.
Well, Amos, you spent a lot of time with Lebanon's Speaker of the Parliament, who's very close to Hezbollah. What did he tell you about Hezbollah's intentions when it comes to Israel?
Well, as you know, Hezbollah and Israel have gone on rounds of conflict over the last several decades, on every several years. We've had relative quiet since the 2006 conflict ended, and through the Security Council Resolution 1701. It has never really been implemented by either side, so we need to get to another point. I think the Speaker, as well as most Lebanese people, they just want this to end. They don't understand why they're at war.
But what tools does the U.S. actually have to pressure Lebanon?
Well, again, we can talk about what does it look like to end not only this round, but to put things in place that will create stability for the long term and bring economic growth and stability and prosperity in Lebanon. It's used to be one of the most successful countries today. They went into total blackout the other day because they lost the last fuel in their power plants. I mean, this is a country that should be prosperous. So that's the kind of things the United States and our allies can do, and I think the people of Lebanon want that. We have to get past this. One of the things that will make it a lot easier to do that, of course, is the ceasefire in Gaza.
Okay, so let's talk about the ceasefire in Gaza. The president said potentially this could be a way to halt Iran from retaliating. Iran has come out overnight and said that's not true, we're going to retaliate. Do you view these talks, which Secretary Blinken is talking about last-ditch final effort basically this week, as halting an Iranian retaliation, or does the administration still expect Iran to retaliate?
Well, I think the president has made clear his expectations when he gave orders for the U.S. military to take several actions to be able to defend both Israel and the region from a potential retaliation from Iran. We don't believe Iran should retaliate, period, but we want to de-escalate, and that's why the U.S. military is there. But at the same time, we are focusing on the diplomatic effort, diplomatic push, and that's why Bill Burns and Brett McGurk were in Cairo and Doha last week, why Secretary Blinken is in the region today and in meeting with Prime Minister Netanyahu just today. The United States put down a draft on Friday, so we're working with the parties to be able to get to an agreement.
Who is at fault here in terms of the gaps? Is it Hamas or is it Benjamin Netanyahu?
I'm not going to go into faults. I think there's no time to waste now, and neither party has an excuse to delay. If you want to bring some relief to the people in Gaza, if you want to bring the hostages home, this is the time to reach an agreement.
Why is this the time?
I think it's been a long time. This conflict has gone on for long enough.
I get that, but we keep hearing that now is the time. Why is now the time? What happens if Secretary Blinken comes back without an agreement?
Well, I don't think he's going there to come back with an agreement. It's just to move the process along in order to get to the point of an agreement. And I think he will do everything that he can. This is the most important moment. There's talks have been intensifying. We've seen what the chances and odds are for escalation. That's not something anybody wants.
I guess another way to put this is, Tony Blinken said that this may be the last chance to reach some sort of ceasefire agreement. What happens after that?
Look, I want to focus today on being able to get there. And so that that's why the president's saying that he's going to put as much of his efforts that he can in order to get to that outcome. That's what we're focused on.
How difficult is the president to put all these efforts in when he's viewed internationally as a lame duck?
I think, first of all, there's one president. He is the president of the United States. I can tell you I've been traveling the world. I don't think that is the view. Everybody knows we have an election coming up. He's the president for the next 6 months. And this is a crisis that cannot wait 6 months. I think everybody knows that. If you're talking about things that will happen over the next several years, then people will focus on talking to the next president, Kamala Harris. But I think that for now, these are not crises. When you talk about the U.S. economy, you talk about the global economy, you talk about the crisis in the Middle East, these are not things that everybody's going to say, well, let's just take a break and wait till January. That can't happen. So that's why you're covering the economy the way you are, and the president gets briefed. The last couple of weeks have seen volatility in the markets. We don't pretend that that we're just going to wait to January.
How often do you speak with the president?
As needed. Some weeks more often.
When was the last time?
Just a few days ago.
Just a few days ago. How engaged is he in these ongoing talks?
Extremely engaged. He has convened his team on a daily basis. He talks to folks to get regular updates. He is very, very engaged. He has calls with world leaders and regional leaders also weekly in order to be able to push this forward. Your future. Does it end with Biden or continue with Harris? I serve President Biden. Ask me that again in 6 months when President Harris takes office. We have to say if, you can say when. We'll talk again in 6 months. Before that, no doubt. It's good to see you, sir. Thank you. White House Senior Energy Advisor Amos Hochstein there.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.